What factors are driving Gary Shilling's warning of a recession? Gary Shilling points to the skyrocketing levels of government and corporate debt as a ticking bomb. When debt grows faster than the economy, it limits the ability of both governments and businesses to respond to shocks. This debt burden can trigger tighter credit conditions and reduce spending, which often precedes recessions. Shilling believes this imbalance will worsen by 2026, making the economy more fragile than many expect. Another key factor is inflation. Shilling warns that inflation won't fade quickly, forcing central banks like the Federal Reserve to keep interest rates high longer than usual. Higher rates increase borrowing costs for consumers and businesses, which dampens spending and investment. This monetary tightening could tip the economy into recession by 2026 as growth slows sharply. Shilling also highlights how a global economic slowdown will amplify risks. With major economies like China and Europe facing slower growth, demand for goods and commodities will fall. This has ripple effects on exports and corporate profits everywhere, including the U.S. As global trade contracts, it could deepen the recession and trigger sharp stock market declines. Finally, Shilling warns that stock markets are overvalued relative to economic fundamentals. Price-to-earnings ratios remain elevated despite rising risks. This imbalance makes markets susceptible to steep corrections once investors factor in slowing growth and higher interest rates. He believes a market plunge in 2026 could wipe out significant wealth and shake confidence. Subscribe for daily answers to questions you didn't know you had.